First, when there's a lot of borrowing to service debt, there's what's called, the death spiral is what we typically refer to that when a company has it, the government can have it too. And that is that dynamic where there's too much debt and you have to borrow to service the debt. And then investors know that that's a problem to service the debt. So the credit is worse. And that means that interest rates go up, which is the worst thing that can happen to a heavily indebted entity. And then as they rise, you get that spiral. You need to borrow more, and so on. So that is also noticed when then there is the key spot is when the debt service becomes large. And then like the real red flag, the biggest red flag is when there's then the selling of the debt beyond the new supply, but the holders of it sell it. And then you can see it in the market action because you can see that long-term interest rates rise while short-term interest rates aren't rising or go down. So it's the free market losing its desire. You have a balance problem in the free market out there. And then you start to see that when the currency then depreciates, particularly relative to gold or Bitcoin or other assets and sometimes other currencies. But typically, these things happen, broadly speaking, together, in which all currencies go down relative to other things like gold, Bitcoin, or tangible values. And so that's what it looks like. That's that edge. Then you start to see, the dynamic. So you either see the central bank comes in very quickly.
I just want to highlight the CBO projection, right? So this is the U.S. government's debt as a percent of the U.S. government's revenue, which you indicate in your book is more important than debt to GDP. You've got to look at the actual revenue being generated by the government and how much debt they have. And the CBO highlights this expansion to 700%, meaning the government is going to have a debt level that's 7 times the income it's making every year over the next, I believe this is a 10-year chart. And you propose a bunch of actions that can keep it flat. And so I just wanted to kind of walk through that, and maybe you could frame this up for us a little bit.
Sure. Like that chart, if you go back to that chart, think about that chart as being, your plaque, so to speak, in the arteries and the debt service. So you could calculate all those numbers and you know what the picture looks like. And that is a stability. So number one is, I call it my 3% solution.
One of the biggest red flags in any economy is the moment when borrowing to service existing debt becomes the primary function of government finances. This phenomenon, often referred to as a debt spiral, occurs when a government, much like a failing corporation, has to borrow continuously, not for new investments or productive purposes, but merely to cover the interest on its outstanding obligations. The market reacts to this in predictable ways. Investors see the increasing risk in holding that nation's debt, which causes credit ratings to worsen, bond yields to rise, and interest rates to increase. For a highly indebted entity, be it a corporation or a sovereign government, rising interest rates are the absolute worst thing that can happen. It is akin to adding weight to a drowning swimmer. At a certain tipping point, the debt burden grows so large that the mere act of servicing it requires massive new issuances of government securities. As investors become skittish, they begin demanding higher yields to compensate for the added risk, pushing interest rates even higher. This vicious cycle accelerates rapidly. The real danger comes when long-term bondholders start liquidating their positions en masse rather than rolling over their holdings, leading to a supply glut in the bond market and a collapse in bond prices. You can see this playing out in real time when long-term yields rise even as short-term interest rates remain flat or even decline, a clear indication that the market is losing faith in the ability of the government to manage its debt effectively. Historically, whenever nations have reached such a breaking point, their currencies have suffered rapid devaluation, particularly against hard assets such as gold and silver. This is where we are today. The currency devaluation may happen in relative terms against other fiat currencies, but more importantly, it is almost always observable in the form of rapidly rising gold prices. That's because gold, unlike paper money, is a tangible store of value that cannot be printed at will by central banks. To understand why gold becomes a safe haven in such times, let's take a closer look at the math behind Treasury yields and inflation. The conventional measure of inflation, the Consumer Price Index, CPI, currently suggests that the US dollar is losing purchasing power at a rate of approximately 2.6% per year. However, anyone who has tracked the cost of healthcare, housing, groceries, or education over the past 2 decades knows that real-world inflation is far higher. A more accurate measure would be somewhere in the range of 7.5% per year, if not more. Now let's compare that with Treasury yields. Suppose you are holding a 10-year U.S. Treasury bond that yields 4.5% annually. If inflation is truly running at 7.5%, then you are effectively losing 3% of your purchasing power each year in real terms. Over a decade, this compounds to a massive loss of wealth. Why would any rational investor accept such a deal? This is precisely why foreign governments, particularly China and Russia, are shifting away from U.S. treasuries and instead accumulating gold at an unprecedented rate. Central banks understand this better than most retail investors. That's why global gold purchases by central banks have doubled over the past 2 years, reaching levels not seen since the post-World War II era. The Chinese in particular have been accumulating gold aggressively while simultaneously reducing their exposure to U.S. debt. This move is not ideological, it is purely mathematical. Holding a U.S. Treasury that guarantees a negative real return is simply a bad investment, whereas holding gold provides long-term stability. As we transition into 2025, expect these trends to accelerate. Governments with weaker currencies and ballooning deficits will face increasing pressure from both domestic and foreign creditors. This will lead to heightened volatility in the bond markets, higher inflation, and ultimately, a global rush into gold and silver as traditional financial instruments become unreliable.
Here, the solution is you must cut the deficit, which is the equivalent of bonds selling, down to 3% of GDP. And it's 7.5% expected. Now, different people have different views as to how to cut it. Forget it. I don't really care. Just you have to have a unified agreement. Everybody in Congress and the president and so on should pledge to do that. And then the question is how to do it. But they should know that number.
That's about $900 billion a year.
Yeah.
Roughly. And that means cutting it, as you point out, by cutting the deficit by more than half from where it sits.
Yeah, well, yes, because with the continuing the tax cuts, Trump's tax cuts, that'll be 7.5%, and you want to get it down to 3%. And it sounds draconian, but we did that kind of change from 1991 till 1997. And there are 3 keys to this. Do it soon, fast, when the time is good, when the economy's good. In other words, do it now.
Now.
Okay. The temptation is going to say, well, we're going to ease into this and we're going to be there and we're going to do it in 3 years from now. But if you have a bad economy, you cannot do it. Okay. And that's the worst. So we have the best economy, and the sooner you do it, the more you're going to do it. So 3% solution, do it now, and recognize that you have to deliver it. So if you're having, let's say, cost cuts in government, you have to own the number. So everybody's got to pledge 3%. Now, there'd be arguments as to how to get there, but you have to own the number. So much so that you'd say, if it's not 3%, throw me out of office, because I've got to deliver that number. The other thing about it is to realize that if you make those moves, the bond market it will benefit. You see, interest
rates will go down.
Right. And interest rates going down, interest rate expense is most important.
So when the president does an interview the other day, and he says, we need to get them to cut interest rates by 1%. And he's speaking about the central bank. He's effectively trying to force the central bank or coerce the central bank to take rate action when, if we were to cut spending, I think this is so important. If the federal government were to cut spending significantly and quickly, the market would naturally react to lower rates.
That's right. Okay.
I think that is so important for everyone to hear.
He's right. If you look at my calculations, you need 100 If you get 100 basis points cut in rates, that's equivalent to significant cutting in spending. So he's right. But if you do that without the other parts, you're going to take money away. You're going to make it less desirable to own these things, these bonds.
Right.
And because that's going to be a problem. Where if you do these things together, they can support each other.
As we navigate through 2025, the financial landscape is shifting dramatically, and nowhere is this more evident than in the changing role of gold and silver in the global monetary system. The persistent devaluation of fiat currencies, aggressive central bank acquisitions, and the growing disillusionment with traditional financial instruments are all setting the stage for a seismic revaluation of precious metals. But before we dive deeper into the implications of this shift, let's take a moment to appreciate just how far we've come. If we look at historical cycles, gold and silver have always played an integral role in preserving wealth, especially in times of monetary turmoil. The very reason gold has been revered for thousands of years is its ability to act as a store of value, immune to the whims of political leaders and central bank policies. It's amusing to think that ancient civilizations, from the Romans to the Chinese dynasties, understood what many modern policymakers still refuse to acknowledge: that paper money backed by nothing is ultimately a short-term experiment bound to fail. One of the key drivers of gold's resurgence has been central bank behavior, particularly in non-Western economies. China, for instance, has been quietly amassing gold reserves at an unprecedented rate. Officially, they report moderate increases in holdings, but many analysts argue that China significantly understates its actual reserves. The same applies to Russia, which has been steadily dumping U.S. treasuries in favor of gold for years. These countries understand that the old financial order, dominated by the U.S. dollar, is losing credibility. And while Western media tends to downplay this trend, the numbers don't lie. The BRICS nations in particular have been pushing for alternatives to the U.S. dollar-dominated system. While the idea of a gold-backed trade settlement currency has been floated multiple times, it hasn't materialized yet, largely because China and India, two of the largest BRICS economies, are cautious about upending the system too abruptly. However, that doesn't mean they aren't preparing for a transition. By accumulating vast amounts of gold, these countries are positioning themselves for a future where gold plays a much more prominent role in international trade and finance. Another crucial aspect of this shift is the gradual erosion of confidence in government bonds, particularly U.S. treasuries. For decades, treasuries were considered the ultimate risk-free asset. But with U.S. debt soaring past $36 trillion in interest payments alone consuming a staggering portion of the federal budget, the idea of risk-free treasuries is beginning to look like a relic of the past. In real terms, the purchasing power of bond yields is being eroded by inflation, creating a scenario where investors are essentially guaranteed to lose value over time. This is exactly the kind of environment that pushes smart money toward gold. We must also consider the role of retail investors in this equation. While institutions and central banks have been quietly increasing their gold holdings, the general public in the West remains largely indifferent. This is, in many ways, the most bullish signal for gold. Historically, gold rallies don't peak until the public jumps in en masse. Right now, gold is still widely misunderstood by the average investor. The mainstream narrative suggests that gold is outdated, irrelevant, and a relic of the past. But if that's the case, why are the world's most powerful financial institutions hoarding it? Silver, often referred to as gold's more volatile cousin, presents an even more compelling case. The silver market is much smaller than the gold market, which means that even modest increases in demand can lead to explosive price movements. Industrial demand for silver is also skyrocketing, particularly due to its critical role in solar panels, electric vehicles, and other green technologies. Unlike gold, which is primarily used as a store of value, silver has a dual role, both as an investment and an industrial metal. This makes it particularly vulnerable to supply shortages, and given the recent depletion of silver stockpiles on major exchanges, a supply crunch seems inevitable. Let's take a moment to reflect on history. The last time gold experienced a major bull run, in the 1970s, it was fueled by many of the same factors we're seeing today: rampant inflation, geopolitical uncertainty, and a loss of confidence in fiat currencies. Back then, gold skyrocketed from $35 per ounce to $850 in less than a decade, a 24-fold increase. If we apply a similar trajectory today, gold could easily reach $10,000 per ounce in the coming years. Some may dismiss this as an unrealistic projection, but consider this: adjusted for real inflation, not the artificially suppressed CPI numbers, gold's previous high in the 1980s would be well above $10,000 today. One area that deserves special attention is silver. Often referred to as gold's volatile cousin, silver has historically outperformed gold in bull markets. The gold-to-silver ratio, which currently sits at around 80-1, suggests that silver is severely undervalued relative to gold. Given silver's industrial demand, particularly in the renewable energy and semiconductor sectors, this imbalance will not last indefinitely. Once investor sentiment shifts and silver catches up to gold, we could see an explosive rally, potentially pushing prices well above $50 per ounce. It is also worth considering the impact of central bank digital currencies, CBDCs, on this dynamic. Governments and central banks are aggressively pushing for digital currencies as a way to maintain control over the financial system. While CBDCs offer efficiency and tracking capabilities, they also pose a significant threat to financial privacy and individual autonomy. A shift towards programmable money, where transactions can be monitored and even restricted based on government policies, is a deeply concerning development. This is where gold and silver provide a unique advantage. Unlike digital currencies, precious metals are tangible assets that cannot be easily confiscated or controlled by the state. They offer financial independence in an era of increasing surveillance and centralization. This is why demand for physical gold and silver is rising, particularly among those who see the writing on the wall. Looking ahead, we can expect increasing volatility in traditional financial markets. The U.S. stock market, which has been artificially propped up by cheap money and corporate buybacks, is showing signs of exhaustion. Bond markets are also under immense pressure, as rising yields make existing debt burdens even more unsustainable. The housing market, once considered a pillar of economic stability, is facing headwinds as higher mortgage rates dampen demand. All of this points to one conclusion: the financial system as we know it is undergoing a major transformation. Those who recognize this shift and position themselves accordingly, by accumulating gold and silver, diversifying into tangible assets, and minimizing exposure to fiat-denominated instruments, will be far better off than those who remain complacent. We are entering a period that will likely resemble the stagflationary era of the 1970s, but with even greater challenges. Back then, gold skyrocketed from $35 to $850 per ounce. If we apply a similar trajectory to today's environment, where monetary debasement and geopolitical instability are even more pronounced, we could see gold reaching $10,000 or higher in the coming years. For investors, the message is clear: do not wait until the crisis unfolds. By the time the mainstream media acknowledges the severity of the situation, it will be too late. Gold and silver are not just hedges against inflation. They are essential tools for preserving wealth in an era of unprecedented financial uncertainty. Whether it is central banks stockpiling gold, BRICS nations working on alternative settlement mechanisms, or investors seeking refuge from a collapsing fiat system, the trajectory is set. The age of unbacked paper currency is drawing to a close, and the return to sound money is on the horizon. As Alasdair MacLeod and other seasoned analysts have pointed out, this shift is not a matter of if, but when. And when the tide turns, those who have prepared in advance will find themselves not just surviving, but thriving in the new financial paradigm.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.